potential for having to have maybe another 200 basis points of easing between now and the end of next year might be a little aggressive.
Do you think we can get to 6,000 on the S&P 500 by the end of the year?
By the end of the year,
how will the first Fed pivot in many years affect earnings, growth, and asset allocation? Here to talk to us about this theme is Jack Janasiewicz. He is the portfolio manager of Natixis Investment Managers, and we'll be talking about his views on the current market landscape. Welcome to the show, Jack.
Oh, thanks for having me on, David.
Jack, let's get your views on what happened at the last FOMC meeting. 50 basis points. Is this enough for a sustained bull market for the next couple of years?
I think the big takeaway is simply that, if you think about the Fed in terms of a risk manager, that risk profile has shifted. They're a dual mandate. They've got the inflation mandate and they've got the labor side of the mandate. I think we're pretty comfortable that inflation is continuing to head towards that 2% target. And now the key risk, I think, is that the unemployment rate starts to drift up. So obviously any slowing in the labor market. And I think the move by going 50 basically puts the Powell put back in play. And it chops off that left tail for risk, so to speak. And so, I think that's a good sign going forward when the Fed is basically telling you, hey, we're worried about downside growth risks, and we're here to support the market if we start to see any deterioration going forward.
This is flip over to my screen here. This is the CME Fed Watch tool. In July 2025, the Fed Watch tool is projecting basically a pretty even chance of either 275 to 300 to 325 basis points, which is roughly about, I would say, almost a 200 basis point drop from where it is today. Now, this is assuming that inflation is going to be on, like you said, on a downward trajectory towards 2%. The Fed themselves, their median forecast, I believe, for next year is somewhere around 3.4%, 3.25%, 3.4%. This is slightly more aggressive. Is the market too aggressive in projecting lower inflation, do you think?
And I think this is our key risk going forward here. We're still in that soft landing camp. And if we're right about that, potential for having to have maybe another 200 basis points of easing between now and the end of next year might be a little aggressive. And again, if we're coming in and growth remains a little more resilient, and that's sort of our base case with that soft landing scenario, the market may have to start pricing out some of those rate cuts. So maybe you get a curve steepener here. The front end stays a little bit pinned or moves up a smidge more. The back end starts to push a little bit higher. You sort of get a little bit of a bear steepener, but I don't think that's necessarily bad because you're now trading off that growth outlook, which is much more positive, I think, longer term.
Okay, what is your outlook for inflation?
Again, I think the risk is that we continue to head below that 2% target and maybe even push lower than that. But a couple of things to think about, right? Right now, what's the problem that's still driving that stickiness? It's still shelter. And I think we all know the story behind shelter. It's lagged the way the calculation works its way through the system. When we look at a lot of those real-time pricing, there certainly looks like there's plenty of disinflation in the pipelines coming. So I think we're going to continue to see things moving lower. I think you're also got the potential for some disinflationary impulses coming from China. That I think is going to potentially weigh on inflation, pushing it lower. And, all these things combined, I think maybe we get to that 2% target. We get a few fits and starts. Maybe we need to rethink about talking about fate, flexible average inflation targeting. We oscillate around 2%. Maybe you get a little bit of an uptick, a little bit of a downtick. But I certainly think the risk is more towards missing to the downside as opposed to inflation reaccelerating back to the upside.
On LinkedIn, you summarized a number of points about your views on the FOMC meeting. So you wrote that the cutting of 50 basis points, this does not make up for cutting 25 basis points in July, which some people have speculated. Rather, it was a function of how much real rates have tightened. And then additionally, you wrote, this sends a powerful signal of commitment that the Fed will not tolerate falling behind the curve and letting the labor market weaken further. The Fed is effectively trimming the left tail risk on growth at a time when recession risks had begun creeping higher. Let's talk about some of these recession risks. You earlier stated that you're still in the soft landing camp, but now you're writing as well that recession risks have started creeping up higher. So what are these risks? And do you think that we're going to be in a soft landing because the Fed is going to be successful in curtailing these risks?
Again, going back to the Powell put being in full force here, I think that certainly helps the odds of a recession continue to push lower. But, again, the risk I think in here is that the labor market continues to deteriorate. When we look at the data right now, I think we're more in what we would consider to be a stasis, right? You're not seeing hirings per se, but we're basically at full employment. And so as we're at full employment or close to full employment, obviously it's a little bit more challenging for the market to add jobs here. So a lot of people, I think, on the bear call are looking at the fact that we're not adding jobs as the precursor to having a weakening labor market. You may not need to see that. This stasis might mean we're at this equilibrium level that persists. And we look at things as to why would companies start to lay people off? Earnings are continuing to grind higher. We're looking at margins that are continuing to improve, and we're looking at things that are still supportive on the growth front there as well. So I don't see reasons for layoffs right now, something we're paying attention to, but I think that's partly why the strength in the labor market persists. Powell even said it himself, right? The time to act is not when the labor market's weakening. The time to act to support the labor market is when it's still strong. And that's what they're doing. And again, I'm not going to continue to harp on this over and over again, but that Powell point, I think, is very important here going forward.
So let's talk about investment implications first before we get on to more of the details of the economy. What then should fund managers do in this situation of declining federal funds rates and a lower inflation? Which sectors should you be prioritizing, and generally, would you be more risk on or risk off?
Yeah, certainly risk on. There's a little bit of a vacuum in here in terms of, I think, important key catalysts. The next big one, obviously, is going to be the start of third quarter earnings season. So a little bit of risk in terms in the short term with the geopolitical backdrop and obviously with the elections. But I think once we get past that, that opens the door up for, I think, us to push higher in here. And one thing to note, when we hear about what's going on with the Beige Book and the ISM, we heard repeatedly that people were saying, we're waiting till after the election to basically get back to business. So again, it's indications that there is some pent-up demand. So with that backdrop, I still think we expect to see tech continuing to work, but maybe we get a broadening out in here. It doesn't have to be the Mag 7, and the Mag 7 doesn't necessarily have to underperform. But I think you could start to see that broadening out where you get things like financials, especially regional banks. Consumer discretionary starts to pick back up again, and even industrial. So things we may lean to in terms of what we call cyclical value. Those are some of the things that we think still continue to work into the end of the year.
Before we continue with the interview, I'm going to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Some of these sectors have started outperforming the S&P 500 in the last couple of months, 3 months, the last quarter. Utilities, consumer staples. So a lot of defensive sectors have seen a lot of market rotation into them. This outperformance, is that the beginning of a larger bull trend, or is this just overbought at this point, do you think?
If I look at what's really driving some of those more defensive sectors, the utilities one, I think, is maybe a proxy for some of the AI trade, right? You need power for all these sort of AI plays to continue to manifest, and that's going to show up in the utility backdrop. The staples one, I think, is a little bit more interesting. I would sort of point to the fact that if you look at the relative performance more recently of discretionaries relative to staples, we're actually pushing back to relative highs. So you're seeing consumer discretionaries now starting to outperform staples. That's telling us that basically the market thinks the consumer's in good shape, which I think is a net positive here. So, from more of these defensive names, I think that was a little bit of catch up, maybe diversifying and taking a little bit of profits out of some of the leaders. But, again, we're not really seeing signs in the broader economy that those defensive names should continue to perform. Look at spreads. Spreads are pushing back to all-time lows in here. That's telling us something, I think.
Do you think we can get to 6,000 on the S&P 500 by the end of the year?
By the end of the year, that's a good call. We'll certainly be pushing higher. How about that into the end of the year? Whether we get to 6,000 or not, tough. But I wouldn't be shocked if we're closing out at all-time highs come December 31st.
Okay, so generally speaking, you're bullish on the stock markets.
Absolutely.
Okay, well, what about the tech sector? The S&P 500 is pretty much dominated by tech now, as is the NASDAQ. Are we still going to see pretty much a divergence between the Mag 7 and everything else, like we saw in 2022 and 2023?
Yeah, I think we expect to see that breadth expand back out again. But again, to be real specific here, I don't think you have to see the Mag 7 and tech in general underperform. I think maybe they can shift to become market performers. I think the bigger issue there is simply you look at the earnings backdrop for these Mag 7 names. They're still putting up excellent earnings. They've still got that pricing power. Margins are still very healthy, but you're seeing the rest of the market sort of catch up as those significant growth rates that we have seen over the last couple of quarters in Mag 7 kind of ease back to, I think, more normal levels here. So, we'll see, I think, a broadening out of breadth. That's very good. That's the lifeblood of a bull market. But I certainly wouldn't discard Mag 7 either. So, I still think there's plenty of room for both sides of that one.
Okay, take a look at this story here. We have people still piling into money market funds. So, according to Bloomberg, story came out this week. Money market funds hit another record with $121 billion of inflows. Investors are still dumping cash into U.S. money market funds, pushing assets under management to a fresh record despite the dawn of the Federal Reserve's interest rate cutting cycle. Some $121 billion was added to the funds the week ending September 25th. Now, the inflows put total assets at a record $6.42 trillion. What's going on here? Are people just locking in rates before they fall even further?
Yeah, I think that's the bottom line here. You still have pretty attractive money market rates, especially when you look at it from a real perspective. I know the Fed just cut by 50 basis points, but inflation continues to head lower, so that real return is still holding up. At some point there, that money market rate probably is going to become a level that's too low as that real rate compresses, and then you'll start to see some of that money move out. But again, I think that money's there just as a safe haven play. It's throwing off a decent yield, something we haven't seen in quite some time. My guess is some of that money is really going to be permanent or sticky.
The story of getting into equities during a declining rate or loosening monetary policy environment. One of the theories is that it may be threatened by high yield products like money market funds or perhaps even defensives like utility stocks that offer dividend yields, or perhaps just corporate fixed income. Now, why would you as a fund manager take on additional risk for going into the tech space or even small caps? I'm not saying you are, but suppose you would be, when you could just go into high yield places when beat the inflation rate.
Sure. And, I think, again, one, that's a product of your risk tolerance, that risk appetite. But the other thing, you've got the upside, I think, in something like equities, whereas if you look historically speaking, high yield spreads, investment grade spreads, closing in on cycle tights here, historical tights. So I think what you're looking at for a lot of those fixed income plays, you're probably just going to be clipping your yield and with maybe a marginal compression on spreads, so you get a little bit more on the total return side. But when I look at the equity sleeve, again, it's that opportunity cost. Earnings are still expanding. You've got the Fed basically easing rates in here. I think from a liquidity perspective, that backdrop is supportive. And so, it's that opportunity cost where you continue to see earnings grinding higher, equities probably grind higher. It's that trade-off. You're looking at potential double-digit returns in equities. Maybe something like high yield gets you to the low double digits, high single digits. It's that upside you're giving away there, the opportunity cost.
Okay, so you're bullish in stocks. What about bonds? Do you think that we're going to get interest rates trailing much lower following the Fed funds rate?
Yeah, so our fair value model for 10s is right around 385. So I think this is probably fair value for the Treasury yield. In general, maybe you get, again, a little bit more of a steepener there. So maybe the back end backs up a smidge more. And as we talked about earlier, maybe the risk is that we've priced in too many rate cuts. So, what potentially could happen more, a back up in the yield curve versus a rally. I think in the near term, maybe you do get a little bit of a backup in the yield curve there. So those are some of the things that we're thinking about. But, listen, corporate America is in great shape, tons of cash on the balance sheet. Interest expense ratios are probably going to be coming down as rates continue to come down. So the ability for a lot of these corporates to finance their debt, it's in pretty good shape. So I think the bond market's in great shape. And, you want to be leaning a little bit more into credit if you're just on the fixed income side, I think.
The 60-40 portfolio failed in 2022 because everything went down. What's different this time?
Yeah, and think about why it went down, right? It was basically because of inflation. Inflation concerns pushed rates higher. And so that duration component made you take losses on your fixed income. And obviously higher rates, bad for the growth outlook, bad for earnings outlook, and that drags down the equity markets as well. So the double whammy there, hitting both sides of the 60-40, resulting from higher inflation. And I think right now we can basically say inflation is on the back burner, and you probably get just the opposite here. Both sides of that portfolio probably work. It's just a question of which one works more.
Well, okay. How do you feel about junk bonds right now? Are we seeing a period of higher yields, but basically a lower probability of default now that we have lower rates?
I think that's the case. Spot on, right? I think, again, the risk of a default rate spike in here, I think, is pretty minimal. So you're going to get your money back come maturity time, and then you're going to get your coupon payments. So again, if you're just considering you want to have a nice steady cash flow with a consistent yield, I think high yield bonds are still going to be able to throw that off. Certainly.
A couple of months ago, people were concerned about the debt maturity wall hitting corporate America, which is to say a lot of companies have to refinance at much higher rates. They couldn't afford to do that, and we could expect a lot of bankruptcies and defaults as a result. Now that rates are starting to come down, is that fear still there? I mean, the Fed just cut by 50 basis points. Is that enough to alleviate the debt maturity wall fears?
Yeah, and the key for that wall of maturity there, the wall of worry, if you will, on the maturity side,
Yeah.
it's really to me a function of risk appetite, right? I mean, the ability to refinance is a function of banks wanting to take on incrementally more risk in terms of rolling over that debt. And so, if there is risk appetite for people to actually take on that debt, that rolling situation is going to continue to push farther and farther out. So, as long as risk appetite stays strong, and I don't see why it shouldn't, given the fact that the Fed is basically telling you that any sort of potential growth slowdown, they're going to stand behind and put a floor underneath that. I think that continues to bolster risk appetite. So, I don't think you're going to have any liquidity issues where banks are not willing to extend credit or private lenders willing to extend credit. And that should just continue to push that wall of maturity out each year. It just keeps rolling another year out.
Okay. So you're not worried about, bottom line, you're not worried about mass defaults and bankruptcies happening in Q4 and Q1 2025?
Nope, we should be good.
Okay. Let's take a look at my screen once more. This is the S&P versus the Russell 2000. So the S&P is the purple line, and the bar chart here is the Russell. Now, year to date, the Russell has underperformed the S&P, up about 11% versus 21% on the S&P. If you zoom in into 3 months, though, we're starting to see a dramatic outperformance of the small caps versus the large caps. This kind of mirrors what I was saying earlier about some of the sectors outperforming the S&P, like utilities, consumer staples, and now we're starting to see small caps do that as well. What are small caps reacting to right now, you think?
We actually have done a lot of work, with my team here internally, our investment committee. I've done some great work over the last couple of weeks on this. And, what's interesting when you look at the top line growth numbers for the Russell 2, so the sales numbers, they're pretty consistent. They're not really being revised higher. But what you are seeing are margins being revised higher. So that operating leverage is what's really falling right to the bottom line here. And even small little turns, because you have such tight margins in the small cap space, you get a 1% increase. That has a big turn in terms of falling right to the bottom line. So I think what the market's looking at is that operating leverage is going to be a key beneficiary of lower rates in here. And that's what I think is you're seeing in terms of driving that small cap performance more recently.
Are we going to continue to see outperformance in the small to mid caps, you think?
That's going to be tricky, and I know a lot of people like to focus on the simple fact that the Fed is cutting as being a significant driver. And, when we go back in history and look, yeah, Fed cuts have certainly helped the small cap space really outperform or have a pretty good pop. But I think the one thing to think about when we have those scenarios in the past, you've always been really seeing a reacceleration in growth, right? The Fed is cutting largely because they're probably behind the curve. The risks of recession are kicking in. Smalls have really already been hammered in terms of price performance. Now you get the Fed cutting, you're getting through the bulk of the recession, you're starting to reaccelerate on the growth front. I think this time around is a little bit different because we're not cutting here because we're on the precipice of a recession. We're cutting because inflation's coming down. So I think for a sustained rally in small caps, you may need to see a reacceleration in growth. And I think that's what makes this one a little bit different than historicals here. So we're still a little bit more hesitant with going, significantly overweight with small caps in here because that missing ingredient might be that reacceleration in that growth story.
Okay. I'm basically showing you a Fed funds versus the S&P 500 chart here. Actually, let me just get rid of this. So I'm going to overlay the S&P 500 with the Fed funds rate. And I've asked this question before to some people, and I just want to get your opinion on why the Fed is cutting once more. Because in the past, as you'll see, what the Fed has done is that in 2020, if you go here in 2020, the Fed cut by 50 basis points when there was basically a huge global pandemic, and so that was a black swan event. 2001, same thing. That was a tech bubble burst, and then the next time they cut by 50 basis points was actually right in the middle of the great financial crisis in 2008. And so the last 3 times they've done a 50 basis point cut, basically, Jack. My point is there was some sort of calamity in the economy. We're not seeing that today, are we?
No, I mean, if I look at the mosaic of the economic data, everything is still in pretty good shape. So I think the answer here is simply, let's look at what inflation has done. So if you look at core PCE, that topped out at around 5.6%. I forget what we had for this morning, but let's say it's down to 2.2, 2.3. So you've had a significant drop in terms of inflation. All the while, the Fed fund rate had been sitting at 5.5%. So by the Fed not following the inflation level lower, that implicitly is pushing the real rate high. And I would argue that at 5.5, 5.25, 5.5 on Fed funds, you're strongly into restrictive territory. So as inflation's coming down, I think the Fed needs to recalibrate to stay in lockstep to make sure that they're not implicitly over tightening. And that's why you saw them go 50. It's really a story of trying to basically keep up with the drop in inflation here and make sure that the restrictive real rates don't become even more restrictive.
Well, do you think these restrictive rates becoming less restrictive will reignite inflation? Now, what point do you think, okay, well, we should be worried about inflation coming back, rates are too low?
I think that's certainly a potential risk in here. That's not our base case, but I think, we've seen a pretty good normalization in a lot of these supply chains, and I think that had a lot to do with it. We're seeing a softening in terms of the labor market, and I think that will also kind of put a little bit of a dampening on the inflation prospects. So, listen, I think at the end of the day here, it's something that we're paying attention to. It certainly is a risk, but it feels like the inertia for inflation is going to continue to push down to that 2% target. And if anything, maybe we end up getting a little below that 2% target.
What happens if we do get below 2%? That would be below the Fed's target. The Fed would have to do something about that. They don't like that. What would they do?
Yeah, and this is where I think that flexible average inflation targeting starts to come back in again, right? It's something that I think Powell had put out a couple of years back and, had to put on the back burner here. But, I think that's something that certainly is going to come back into play. When you want to see inflation roughly hold about 2%, you might have a little bit of an overshoot. You might have a little bit of an undershoot. But, again, I think you'll see them trying to manage that downside by getting that sort of restrictive level on Fed funds down faster if that's the key risk they see continuing to manifest in here.
What do the markets like when it comes to inflation? If you take a look at my chart here, this is the CPI inflation rate. Post-financial crisis, we had a period when inflation after 2012 fell to a pretty consistent level between 0%. At one point, it was actually deflationary, negative 0.1% in 2015, 0 to 2%, and 2.7 at one point before spiking all the way up during the pandemic. That was coincided with a period of not arguably, but the longest bull market in American stock market history. So I'm guessing the stock market's like a consistent range of low inflation. Is that true?
Yeah, I think it's predictability, right? They don't want any surprises on the inflation front because they're trying to project out over the next 5-10 years in terms of CapEx and really trying to budget out what they want to be spending and so forth in here. So, I think that 2% range, give or take, that's enough to see prices continuing to push higher, which also helps the top line levels. Companies in the U.S. have done a very good job of managing expenses. As I mentioned earlier, we continue to see margins drifting higher. So I think that's a very, very big tell in terms of a lot of these companies and their ability to manage expenses. And that obviously that operating leverage flows right to the bottom line here. So, that 2% give or take inflation backdrop, that's the sweet spot, I think, for corporate earnings. And that's exactly what they want.
I like to just close off on your longer term outlook here. If you take a look at the S&P 500 over the course of the last 25 years, between 2000 and 2008, was basically flat if you discount the fact that it went down significantly post the tech bubble bust, and it took years to recover to its pre-tech bubble highs. Same thing with the NASDAQ. Now, the following subsequent 10 years was not the same. The subsequent 10 years, like I told you, was the longest bull market in American history, and the stock markets have grinded a lot higher since the great financial crisis. Is the environment today ripe for another 10-year bull rally of similar magnitude, Jack, or the other camp thinks that the next 10 years will see much lower real returns on equities?
I think the key here really falls back on the demographic story, right? And that demographic story really plays into the millennials. And when you think about really the sweet spot for household formation, you're in between the ages of 30 and 45. And that's really when you start to think about where the millennial bulge starts to hit in. We're at the early ages or the early stages of that sort of that bulge in that income bracket, if you will. So, as these millennials continue to sort of become, household formation kicks in, they move up the chain in terms of their earnings. That means they're going to be spending more, savings more. And that's going to flow its way back into both the stock market and corporate earnings. So that demographic backdrop, which is being highly supported by millennials, I think is key to think about the next 10 years. And I don't think we really start to roll over in terms of that growth rate until we get to the back half of maybe 2028, 2029. in here. And so I think that is one of the key things to think about is that demographics, and it's highly supportive because of the millennials in here.
Well, do you think the millennials are in a position to spend as much as the boomers?
Well, if that wealth transfer, when those boomers start to move on, if that wealth transfer starts to move, you're going to be looking at things moving from highly conservative investment positions back to probably something more aggressive, and I'm sure some of that's going to filter right back into spending. Period. So I think there's a little bit to be said for that. Continue that wealth transfer as helping out in terms of potential spending going forward.
Well, that is a very interesting point. The wealth transfer from the boomers to the millennials. How do you see spending patterns or spending habits change between the generations, and how would that ultimately affect which sectors you're going to prioritize?
Yeah, and I think the obvious one, healthcare to probably something more on travel and leisure, household formation, so maybe more on the consumer discretionary side, those sort of things. So a little bit more on what I would argue is basically the cyclical side of the equation. So that's, I think, going to be one of the key supportive backdrops for the cyclical story going forward here over the next couple of years.
Is tech going to be the new utility sector, you think?
It certainly feels like it, right? I mean, we've already seen sort of those defensive characteristics for the Mag 7, which is partly why, I don't think you can write that off. Maybe we get a few names that sort of drift up and become the new Mag 7 in here. But, again, zero debt, tons of cash, products that we use every day, wide moat businesses. Those are pretty good characteristics, I think, in here in terms of thinking about potential defensive plays, especially when you're looking at keeping equity risk on your books.
Just going back to why the stock markets didn't recover post 2001 until 10 years later. Take a look at the Fed funds rate. One theory is that cheap money wasn't abundant or as abundant in that decade as it was following the great financial crisis of 2008. So you can see after 2001, after we had a recession, the Fed funds rate stabilized around 1% before going back up. Now, it was on a decline, but it was still much higher than basically zero, which is what we have for an entire decade. Is cheap money the reason for why this entire decade saw the longest bull rally in American history?
I think that's part of it. I think you've also got that low inflation backdrop in there, and some of the productivity gains starting to kick in as well. So, again, thinking about that sweet spot for equity markets, and really that's being driven by earnings. Modest growth, no inflation, easy financing, and easy credit being available. That's a pretty good story in terms of seeing earnings continue to push higher.
And to your point about inflation not coming back, so we have to remember that during this time inflation was low and the Fed funds rate was zero. People concerned about inflation coming back because the Fed funds rate is dropping from 5% have to remember that we had 0% rates and still very, very low inflation. How would you explain that phenomenon?
Yeah, and it's an interesting backdrop. Again, I think some of this is simply that when you look at the availability of credit, that's certainly out there. The cost of credit can be certainly out there. But if there's really a lack or an incentive of wanting to use it, then it doesn't really matter, right? It's sort of like I can lead a horse to water, but you can't make it drink, so to speak. People have to have that risk appetite to be able to want to borrow because they see opportunity out there. And I think that's the key when we think about not just really this time period you're talking about, but I think in how we approach the markets in general, right? It's all about risk appetite. If there's risk appetite, you can certainly see the market overshoot, whether it's looking at valuations or just absolute levels. If there's risk appetite in the marketplace, we're going to see, I think, the market go farther than a lot of people think. And that I think is what the bottom line here is in a lot of what we've been talking about. All comes down to risk appetite.
Jack, thanks very much for your time today. Where can we learn more about you and your funds?
Sure. As you mentioned earlier, I post on LinkedIn. So if anybody wants to see some of the commentary on LinkedIn, it's out there. And obviously you can head over to the Natixis website, and we've got stuff out there that you can browse through and see the other things that we have to offer as well.
Well, let's close off on this. Major risks that would derail your bullish outlook. What would they be?
Yeah, I mean, listen, the soft landing scenario, I think, resides on the health of the labor market. And if for whatever reason we start to see a significant deterioration in the job market, that's the first risk. The second one, I would say, watch the geopolitical tensions coming out of the Middle East. If that continues to, evolve and start to become a little bit more involved with Iran, that's obviously going to be a key risk. And then the last one, again, it goes back to that interest rate story. Maybe we've priced in too much. Things end up being better than expected. And as a result, rates may be pushed higher aggressively, maybe more so than the market's expecting. And that forces maybe at least an interim correction in here.
Fantastic. Thank you very much, Jack. And people can follow Jack in the links down below. And thank you for watching. Don't forget to like and subscribe.